Kris Krohn here with Limitless TV, and today we're going back to some Q&A. I cannot believe how many incredible questions you guys have. You're inspiring new videos, new topics, and it is important for me to get your questions answered. So today I'm going to handle about a dozen of them and get you the answers that you've been looking for. All right, let's get started. First question today comes from James Picklebutt. James, thank you for this question. James asks, he says, okay, Limitless TV, super inspiring. Kris, I got $100,000 of equity in my home, and right now I tried to get a home equity line, and they're offering me a 13% interest rate, or I can take my 4% loan and do a cash out refinance between 4.5% and 5%. What do you think I should do? Oh my goodness, you've got three options right now, and I'm going to give them to you right now, James. Number one is, I don't know what is happening with the bank you're talking to on a home equity line of credit, but home equity line of credits are usually cheaper than a cash out refinance. So please go talk to a couple of different banks. The only reason why they'd be quoting something higher is if they're a non-traditional bank, or you're talking to a hard money father-in-law kind of person, a loan shark, something strange is going on, or you don't have good credit. But I'm thinking you do have good credit, because your second option is you're thinking, oh man, Kris, do I really want to pay for a cash out refinance and go from an awesome juicy 4% rate to maybe a 5% rate? That's not a bad option. Remember, it's all about the arbitrage. If I get, let's say of the 100,000, let's say I get 50,000 out. Can I place my $50,000 somewhere that makes up the difference in that 1% cost of increased rate on the rest? And with me, of course you can. There are plenty of options. We'll talk about that too. So this is a really great question. Right now you should be able to secure a home equity line, and it's going to be between 3 and 4%. If for whatever strange, bizarre reason that doesn't work, then I want you to go to the cash out refi at 4 to 5%. And if you just had all around bad credit, James, sell the property. I know you're thinking, wait, Kris, I have a home. Why would I sell it? You got $100,000 of equity. Go take that money and put it into 3 properties. If you want help knowing how to do these things, then click the link below. And in the notes section, make sure you tell me, James, maybe with your real name, not Picklebutt, exactly what you want to do, what you have available, and I'll have my lending team jump in, give you all your options, and we can even talk about me supplying you with properties to help you actually get that moving forward. Fantastic question. A lot of people in your situation. In fact, if you're watching this video and you've got equity, that equity doesn't mean anything unless it's working for you. So if it's equity in a home, it's doing nothing, losing at the rate of inflation. But if it's equity in investment property, how do you put that into another property and start working on those infinite returns by velocitizing your money, by having the same dollar that was sitting here now sitting in 2 places? All right. Next question comes from Eric Boyd. In a previous Q&A, you said that you prefer single-family homes over condos because they generally appreciate in value more. He said this makes sense. Do 2 or 3 or even 4 family homes appreciate similarly to a single family house in the right market? Okay, hands down across the board, Eric, you're going to see single family homes are going to travel better than townhomes. They're going to travel better and appreciate better than condos. And they're also going to do better than multifamily homes when you're talking about duplexes, triplexes, and fourplexes. Single family homes, it is a sweet spot below the median and 3-bedroom homes and greater. Okay, next question comes from Silent Gamer. Not so silent today. Ha ha ha. What do you think about the idea? I could be such a nerd in my head. You guys make me so happy. I don't even know if you know you're doing it. What do you think about the idea of buying a rental and pay as least as possible towards the mortgage and keep whatever is left over from monthly rent and do the process over again? Okay, Silent Gamer has a fantastic question. Basically says, Kris, when I buy a house, I could do a 30-year mortgage. I could do a 15-year mortgage. I could do like an interest-only mortgage. What should I do? And I want to tell you something, that as long as it is not a negative amortization mortgage, they don't even exist anymore. That was an 05, 06, 07 product. But they may come back, so you got to be super careful. I'm dropping it for you. The question is, should I try to get the lowest interest rate and instead of trying to pay off the house, put it towards my next investment? Yes, Silent Gamer, that is exactly what you want to do. Snowball. I was just sitting down with one of my clients. They had bought 4 homes with me, and we had partnered on some stuff, and they were making $80,000 on each one of their homes. So think about that. 4 homes times $80,000. They were doing pretty well, over $300,000. And I went back and I said, what do you want to do now? They said, Kris, we wish that we had bought 10 homes instead of 4. And Silent Gamer, that's what you're talking about. More real estate done the right way is always more better. And it's also more funner. Next question comes from Country Living. We're selling our home in West Virginia. We want to move back to Pennsylvania, but we can't get a loan. However, we own our home outright. What are our options? Okay, this is a fantastic question. Option number 1, sell the house. Homes that you've been living in and are owned, paid off outright, don't always make the best rentals, especially if you're moving out of state. I do not like owning out-of-state property if I only have one home out there because I've got no loyalty with the property manager. I'm worth $100 a month to him. You do not buy loyalty for $100 a month. So number 1 option, sell the home. And my advice is, sure, you could buy your house paid off in Pennsylvania, but frankly, it might be better to put a 20 or 30% down payment and have the rest of the money sitting in investment properties, producing more cash flow and building more equity than paying off the house itself. Country Living, those are your 2 best options, because if you can't get a loan, then selling it and placing it that way is something that'll help you. You might be saying, but Kris, if I can't get a loan, then I have to use the money to pay off my home in Pennsylvania. This is not true. If you can't get the loan, you have other options. You can co-sign. There are credit partners. I have my partners all the time come to me with piles of money. They want investment properties. They want retirement income, but guess what? They don't have the credit. So you know what I do? I rent somebody else's credit, safe and secure, and it works. You got options. If you want to pursue any of those, click the form below and let me know, and I'll have my team be in touch with you. Next question comes from Jomar Johnson. He says, Kris, in one of your videos, you talked about buying a primary residence with 3% down, but if you do this, aren't you going to have homeowners insurance and mortgage insurance? Well, you're always going to have homeowners insurance. Mortgage insurance is usually what you have on a property until it's 20% paid off. And you know what? It is a cost of doing business in real estate. It's not always avoidable. But I'll tell you what, I would rather have mortgage insurance and put 3% down and walk into a pirate booty of equity rather than waiting to have a 20% down payment, which might take me a lot more time and many, many more years, all because I was trying to avoid perhaps $100 or $200 a month on the mortgage insurance. It's not a deal killer. Okay, next question comes from Unsought Bar 888. What taxes are you responsible for when renting out your property? This is a fantastic question. If you're renting out a property that already has a mortgage in place, you might have already wrapped in your PITI, principal, interest, taxes, and insurance. So generally the landlord is responsible for all those taxes. I'm not really aware of a landlord that ever went to a tenant and said, hey, this is what your rent is, but then you also got to pay extra for taxes. It might exist, but in my hundreds and hundreds and hundreds and thousands of homes, I've never actually encountered that. So generally all that's on you and it's not on your tenant. Okay, Eddie Cervantes, great question. He says, do you think investing in commercial property is more profitable than investing in homes? Eddie, it absolutely can be. It's just that commercial usually takes a lot more money. Now, I don't get interested in commercial generally until there's a lot more money that needs to go into it. I was sitting down with some of the others that are like, Kris, why aren't you doing just one big commercial project instead of 500 little baby houses? Because I have a system in place. I love the diversification of 500 baby houses. This last month I sold 5 houses. I did not put any money in these houses years ago. My partners got their down payment back, and then we each got $10,000 to $25,000 on every one of these homes that we sold. And so if you think about it, those homes, I got great diversification. It's easier to liquidate lots of different little assets. Some people will argue it's a lot of extra work. I don't think so if you've built the right team. I will look into commercial. I do commercial deals, especially when they have really compelling ROIs. If they're just comparable to my single families, I don't touch them. And in real estate, where I'm averaging 10 to 20% a year on my single family homes, there's not really much reason to go into commercial. Sometimes commercial requires a lot more money, and it can be a lot more extra money. And don't ever put all your eggs in one basket, because if it was scraping everything together to do the commercial deal, I would say no bueno. I want you to go back and I want you to do a pile of single family homes. You're ready for commercial when you got a massive chunk you can put in, but it is only a minority of your total asset base. Fantastic question. Okay, from Derek C. Can you explain how you use an LLC to mitigate your risk as an investor? You know, It's interesting. An LLC has protected me from time to time. But in the end, I don't want you to think that it is this crazy bulletproof system. There are some things out there that are crazy bulletproof, like life insurance. I stash lots of money in life insurance because, you know, lawsuits can't get to it. Governments can't regulate it. They can't get their hands in that cookie jar. What an LLC does is it tries to create a bifurcation between your personal and your business. And you're only going to be able to protect what you put in the LLC. I would never, for example, take my art business of things that I paint and my real estate business and commingle them. Because if I have a problem in one business, it bleeds into my second. So I will use as many LLCs as it takes to create separation in my different business endeavors. There are LLCs out there called series LLCs. These are proven to create a single entity LLC, but with individual protection per property. So it's like an LLC with corporate veil protection between all the different properties. They're more money generally to set up, and so I don't set them up because your likelihood of getting hit is very, very small. When someone has an issue on a house, they're not trying to attack all your assets. Generally, they're attacking the house, and the house will take care of most things. Remember, you got homeowners insurance, and you have to have that. It's super important. That'll take care of 99% of problems that happen less than 1% of the time. But should it escape and go outside of that, it could hit the other assets in the LLC. So it's meant to create a corporate veil of protection between assets. This video is going long, but I got 6 more questions. So now I'm gonna revert to my short, quick answers, okay? First one comes from Jesus Jimenez. He says, hey Kris, not sure if you've answered this question, but basically my parents used my credit to buy their house and now they don't wanna refinance it, but I wanna buy another house, so what should I do? Fantastic question. You're wondering whether you should put more money down on the next house, but I'd tell you this, put your parents on title and then have them do a rate and term refinance. What that means is you're not trying to pull money out, you're just trying to shift control so that it comes off of your credit. And that kind of refinance, the only reason why they wouldn't be able to do that is if they don't have the credit to be able to refinance. If they do and if they can, they should. And a refinance is easier than a purchase. So make sure that they are reflected on title, and a refinance is going to be way easier because they're already owning the home. So do that. This next one comes from Gabe B. Kris, love your questions. I've got a question. I own a duplex with a partner. I was the hard money. It's gone up $50,000 in value. I was the hard money lender, but now my partner wants to buy me out. And the question is, should we split the equity? The answer is yes, you split the equity. So you get your money out, and if there's $50,000 of equity, a true fair buyout at fair market value would be you getting $25,000 of the $50,000. Now, sometimes we're not acting at fair market value, and sometimes partners will be more conservative, and your partner might say, hey, I only think that 30,000 of that is fair. Let's split it 15,000, 15,000. But either way, you should get credit. Shellfish, when renting out a house, should I report it on my taxes? Yes, do this. Maria Quintanilla. Hello, I love your videos. They're very motivating. Thank you. I got a question. I got $8,000 saved up, but tons of money in my 401k. If I pull it out of my 401k, there will be taxes and penalties. Should I do this? Maria, yes. This is actually what I specialize in. I get really fired up about 401ks and IRAs and these ridiculous vehicles that are my money that, I'm not going to start. Go watch one of my videos. I'll rant on it. Here's what I'm basically saying. Yes, use your 401k. Your money sitting in real estate will do way better for you than sitting in your 401k. Is it worth it to pay the tax and penalties? Always. Why? Because until you wait to a certain age, all you're going to do is avoid the penalty. You're always going to have to pay your taxes. So you know what? Take the tiny hit and get your money working for you. If you have questions on how to do that, or if you want to partner and do a pile of deals with me, I want you to click down below, hit the link, and put that in the request, and my team will contact you and get some basic information, and we'll be able to share with you specifically all your options of what you can do. RT happens. Love your videos tons. Very useful. Question. Quicken loans or not? Answer. Depends. Is it a good rate? If it's not, don't do it. Is it a bad rate, but you have an investment that earns you a high profit margin? Maybe it's worth it. It's all opportunity cost. If you can qualify for Quicken loans, you can probably qualify for some others as well. Okay, John Berguti. Once the house is acquired, what is the best way to get the house rented out? John, hire a property manager. That is have them do it. They're going to charge you 8 to 10% of the gross rent that they collect, and it's their responsibility. Go with a successful firm. Go with the firm that has lots of houses. They're getting lots of calls, and they can refer people to your specific house. If you want to do it yourself, go to my lease option video where I'm going to show you how to put obnoxious, bright, neon-colored signs in the lawn, and trust me, it's going to pick up the attention of people that may want to do a rent-to-own. It'll mean self-managed. It'll mean more cash flow. It'll also mean down payment. I'm a fan of that. If you got a little extra time, that's the way to go. Okay, friends, thanks so much. These are fantastic questions. Thank you for watching today's video. And if you have more questions, be sure that you respond below. If you're not a member of our tribe, then go ahead and subscribe and post your questions so that we can make more videos and more Q&A videos to make sure you got everything that you need to succeed, from real estate investing to having a powerful, rock-solid mindset.